There are a couple options available for controlling and reducing cost. One that I am ever so fond of is writing modified master policies. So maybe not writing every property you own on a single policy form, but instead grouping them by like characteristics. So your apartment buildings in Michigan, your apartment buildings in Tennessee, your apartment buildings in Arizona. Maybe break that up into three policies at the state level, kind of slice it into pieces to keep it in small market.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Well, our guest today is an expert in part of the business that you better have an expert in, no matter who you are. If you're an active investor or if you're a passive investor, you better make sure your operators you're investing with has somebody on their team that's an expert in insurance, right? You hope that they're insuring the property properly that you're investing in, right? And I think too often that you just look at the rate and make sure it's the lowest rate possible, right? And then you go with that one, not only to find out maybe after a fire or after some damage that you didn't have enough coverage, right? Or they're only going to pay out a quarter of what's needed to rebuild that property, right? Or that piece of the property, or whatever it may be. And so this is why it's so important. Our guest today, his name is Calvin Roberts, and he's a principal at Falcon Insurance Agency of Michigan, and he's based in Ann Arbor, Michigan. It leverages technology, automation, and AI. His team has over 100 years of combined experience. He has previous background as a sales manager at Allstate, a commercial agency agent at Heidi agency, commercial risk advisors at Shield Insurance Agency. So he's been a number of different places, and we talk about his growth through this industry as well, and his knowledge base now as far as helping people like us in commercial real estate. We talk a lot about a master policy approach and what that is, how maybe that could save your portfolio of properties a lot of money. And he's going to dive in some pros and cons of just that you need to know. Well, I don't care what kind of real estate you own today, you better have some insurance on it. Our guest today is an expert in just that. Calvin, welcome to the show.
Thank you very much for having me, Whitney. It's my pleasure to speak with you.
Yeah, it's a topic that we need. If you're in commercial real estate, you better know something about real estate, but ultimately you better have somebody that's the true expert. I feel like it's one of those pieces of the team, right? That's crucially important that you have an expert in your pocket, somebody that you can reach out to and know, and that you're on top of the top type of insurance that you need. We're going to get into a few of those things today, but I want to jump right in, Calvin. But before we do, and we get to a couple of things I know all the listeners want to know, give us a little bit about your background, your background in insurance and before insurance, maybe.
Excellent. I've been in the industry. I'm going into my 8th year. I started off as a humble Allstate insurance agent and quickly worked my way up to agency sales manager and then big boss of the agency with a total of 10 staff and 2 offices and approximately a $6 million book of business. I stayed with that firm for about 2 years. The pain point I experienced, which prompted me to move onward and kind of look upward, is as an Allstate agent, it's like having your hands tied behind your back, only being able to sell to one company. I saw all of these independent agencies, frequently humbling me, and knew that that was really where the longevity in the industry seemed to be heading. So I moved on to an independent agency based in downtown Ann Arbor, worked with them for about 2 years, and it was a great experience, kind of cutting my teeth in the exciting indie world. But just like any real estate investor, I would like to own the fruits of my labor. And I had no contractual ownership of my book of business. So in April 2020, right about the same time as all of the, stay-at-home orders, I split off. I had a good friend who he had just formed his own firm on January 1st of 2020. And he had been kind of chomping at the bit to try to get me to come over, work with him on a 1099 relationship where I own my book of business. I get paid on the renewals. And I said, hey, if there's any time to kind of bite the bullet and restart from zero, it's right now. So I worked with the Michigan Choice Insurance Agency for about 2 years from then. And then in February of 2022, my book of business had hit that critical mass where I knew I could split off, form my own firm, be able to attract contracts from large insurance companies because we had enough premium volume on the books. So it was a very nice launching pad for what is now the Falcon Insurance Agency of Michigan. We're licensed in 39 states today. We have around a $4 million book of business. We insure somewhere around 14,000 doors across the country. And I joke to my clients that I like big buildings and I cannot lie.
Wow. Well, congratulations to your success. That's incredible. Just your the stepping stones there, right? You took and moving forward and upward, like you said. But it's it's nerve wracking sometimes, right? Taking that leap, but if you're not willing to take any risk, you're not going to go very far, right? So it sounds like you did, and you've been successful at it, and currently insuring 14,000 doors. That's very impressive, and it seemed like in really a short period of time. Right. And you've accomplished a lot. Well, in doing that and working for different groups like that, from Allstate to an independent agency, and now for yourself, let's jump in. I know listeners, want to know about the state of commercial property insurance, just that marketplace, for 2023 and what you see into the future. I know they don't want to wait 20 minutes for me to get to that question.
So the short answer is that I don't come with much good news today. It's pretty much all bad, at least for the immediate to possibly medium term time horizon. There are a couple factors that are really driving the changes that we're seeing in the commercial property insurance landscape. The first on everyone's mind is inflation. A building that cost $1 million to rebuild before COVID probably costs around 1.6, 1.7, maybe more to build that same property today. As the cost to repair or replace increases, i.e., the exposure, the premium that you pay linearly will scale with that. It's a tough time right now. I mean, I see large established players who've been providing multifamily insurance for years, either pausing new business like Nationwide did earlier this month, where they're not writing any new multifamily as of June 30th, or completely pulling out of the market. I mean, I think it was last year, American Family pulled out of habitational. They're not writing any new hab business. Farm Bureau in Michigan, they believe on October 15th, 2022, completely pumped the brakes on new habitational business. So you're seeing a lot of the kind of bedrock players providing cover for multifamily businesses pulling out left and right because they just can't make money as hard as they try. So it's a exciting time.
So, what is, or I guess Falcon's providing insurance or on those though?
Yes, sir. So I keep a very sharp tool set, is how I'll phrase it. We bring very good business to our carrier partners. So Westfield Insurance, for example, they're based in Ohio. They're what's called a super regional company. They're not like a State Farm or a Travelers where they're in all 50 states. Westfield is in, I believe, 14 or 15 states today. We are their number one producing agency in Michigan this year. And as a result, I found that they are fairly satisfied with our diligence on the frontline underwriting. Our book has performed very well for them. So they will write multifamily accounts for us that they would not underwrite for most other agencies because we have a proven track record of writing good business for them.
Yeah. What about, in this train of thought while we're on it, talking about the current marketplace for insurance, and it's interesting, many agencies not providing, just saying, hey, we're not doing it now. That would lead me to believe, hey, if you can find somebody to do it, it's going to be more expensive. Right.
There are a couple options available for controlling and reducing cost. One that I am ever so fond of is writing modified master policies. So maybe not writing every property you own on a single policy form, but instead grouping them by like characteristics. So your apartment buildings in Michigan, your apartment buildings in Tennessee, your apartment buildings in Arizona. Maybe break that up into 3 policies at the state level, or they're kind of slice it into pieces to keep it in small market. So just the lower level of commercial insurance where there's typically less rigorous underwriting steps involved. And then what I like to do in markets that are not catastrophic exposed, like the Gulf Coast or like some of the wildfire regions out west. If you have, let's say, 10 apartment complexes in Michigan with 40 doors average per, instead of insuring the entire portfolio or that portion of the portfolio for the full cost to repair or rebuild, I would blanket coverage, which is where instead of each building having its own unique limit, there's just a general policy limit for building coverage. And then I would write each building at 80% of what it would cost to rebuild. So if all 10 apartment complexes burn to the ground in unison, sure, you would only have enough, claim settlement to rebuild 80% of it. But in non-catastrophic exposed markets like the Midwest, like much of the Southeast, I don't think that that's very likely to happen. And if it were to happen, I think we have bigger concerns at that point than an insurance payment.
Right. So you may not do, say, 2 projects that are right next to each other on the coast, in Florida, right? The likelihood one of them gets wiped out by a tsunami, the other one's probably going to get wiped out as well, right? But if they were, one on the coast and one, in I don't know, Atlanta, well, maybe that might work, or further inland, whatever it may be, right? That might be a path for that. And so you called it a master policy. We've not talked about that too many times on the show. And so, speak to, is that for specific operators? Is that kind of anybody could qualify for that, or certain size property or certain size operator, or portfolio? Who would qualify for that? And when should we look into that?
So I try to write with the master policy approach for most investors. My thought process generally is to avoid breaking an account up into a million different pieces. I will break an account up. So instead of having just one master policy, like I see some of my larger peers and colleagues take the approach of often, I'll instead break it up into a couple of master policies. And this has pros and cons, but the main pro is that it makes us much more nimble. So if one of those accounts gets a renewal, which you don't believe is favorable, it's much easier to remarket 10 locations on a policy together versus 100 across the entire portfolio. Makes it so that we're able to respond to changes in the marketplace much more effectively versus, kind of cramming a triangle into a circle-shaped hole with a single master policy approach. I would say that this is especially true for kind of the more residential 1 to 4 family rental property type of investor. You don't want to have 30 different policies for your 30 duplex properties. It's just not a very effective way of achieving insurance coverage across the portfolio. Not necessarily just on price, but also on preserving your sanity. You don't want to be negotiating 30 renewals every year, etc. It just, the administrative bloat factor kind of comes into effect there also. So that's why I believe it's a good idea to group like assets and try to keep it within small market underwriting. Makes it so you're able to fit into companies who have attractive pricing in what I view as kind of an underwriting blind spot. Because in middle market for larger accounts, the underwriting process is typically much more involved and substantially more rigorous throughout.
Yeah. Well, what about, I was thinking about, if we had 10 properties in a master policy, but we're buying and selling, those projects individually, how does that work? As far as ensuring we have coverage, right? But we're transacting, inside those units as well.
So for the buy and sell type of investor, that's who I believe the master policy approach really offers the most administrative benefit to, because it's a simple add delete mechanism. And then you just account for the premium specific to each location. And then let's say you have a monthly billing plan, you determine which we assist with this, but you determine the percent of premium for each property, and then just multiply that against your monthly bill factor. That tells you the exact premium to charge back against each LLC or whichever entity might own the properties.
What would be the cons of having a master policy like that? Or maybe, it's like, wait a minute, this is you, this does not apply to you, or you need to know this beforehand.
So it makes it so that if, let's say, you're buying a new 8-unit apartment building, and perhaps you have two partners who are, the investors putting up capital for this project, it makes it so that we're less nimble in terms of being able to really dial in the pricing on a per location basis. With master policies, you look at the pricing as an aggregate across the entire portfolio. But if you have two partners in this deal, I mean, sure, the price that you're paying on average might be attractive across the master policy. But if for the one location that they have a financial interest in feels high, just makes it so that we're not as effectively able to dial in the price on a per location basis as we might need it to be.
Yeah. Wow. So, what about, I don't know, just thinking about, why don't more people do it that way or have a master policy?
It's a school of thought that differs between insurance brokers, and I view it largely as reflective of the experience level of that broker on real estate accounts. Someone who is more of a generalist insurance broker, they have some real estate accounts, they have some restaurants, they have some contractors, just a little bit of everything without really specializing in any one segment. They don't foresee the administrative effect and headache that will create for the client, especially in a scenario where, let's say you own 500 apartment units in Tennessee, and maybe it's 15 apartment complexes that total that. You have a really bad fire loss at one of those locations. If that location gets non-renewed, which it probably will, because there's not sufficient premium volume associated with the account to make the trailing loss ratio attractive for the insurer to stay on the account, remarketing that one location with losses becomes a challenge. So really it smooths pricing across the portfolio. And there's pros and cons to, this approach in the sense of, should we have one master policy? Should we have maybe a couple of master policies? I try to not write a single master policy for very large or maybe even a mid-size plus portfolio. Instead, I'll break it up into 2, 3, 4, 5 pieces. For example, we have one where they're a Class C plus, B minus multifamily investor active in the Lansing and Kalamazoo, Michigan markets with about 1,100 doors. We're planning on taking over most of this account on 7/14 next Friday. This account, we broke up a single master policy into 7 pieces. And really the advantage of this is that I'm able to get a company who won't underwrite the entire thing on one policy, but has that very attractive pricing to take the deal. You break it off into bite-sized chunks, and it makes insurance companies who would say no in middle market more willing to say yes in small market, because it's a different set of underwriting rules. You're working with a different underwriter. So at that point, it's someone else's judgment call if they want to take the account.
Yeah. Yeah. Wow. Well, you speak to expectations of insurance, in years to come, right? We talked about, maybe it's not so great at the moment, current or in the immediate future, but what about, years to come? What do you see or expect, or what should we expect?
I would anticipate by 2025 or 26, you'll begin to see more stability in the marketplace. What's really driving the rapid hardening of the commercial property marketplace at least in Q1 and Q2 2023, is the inavailability of access to reinsurance capital. Reinsurance is insurance for insurance companies. It's if you're Hanover or auto owners, and maybe you have some exposure to hurricanes or hail or whatever kind of catastrophic, big sudden loss event like that. You don't want to sit on a liquid, $15 billion reserve. It's more efficient use of capital to sit on maybe a $5 billion reserve that's fairly liquid, and then buy reinsurance for events that exceed which you have direct reserve capacity for. Ironically, because of interest rates going up, that has caused a exodus of capital from the reinsurance markets, where as interest rates have gone back up, suddenly investment capital does not need to seek out riskier and riskier investment vehicles to find that same return. They can go back to a safer investment vehicle. That's resulting in a diminishing availability of capital in the reinsurance markets. I believe that you'll see greater capital come into the reinsurance market probably over the next year and a half. And from there, things should start to stabilize. But really, it's the factor of increasing interest rates, along with some of the large cat events that happened in 2022, like the 2 hurricanes that hit the US Southeast. There were some wildfires out west. We had hailstorms throughout the Midwest. Those events took a toll on reinsurance. So we're starting to see a restabilization of that market, which will then spill over into the primary insurance marketplace, like what we buy from Travelers or Liberty Mutual or whoever else.
Yeah. Any other tips on the master policy or what to expect that maybe I didn't know to ask you about insurance before we move to a few final questions?
Ask to see your insurance broker's marketing report. Ask them to show their cards, lay out on the table all of the companies that they approached for your renewal or new acquisition, what the price was, if they quoted it, if they declined, what the reasoning was for that declination. And if the list appears to demonstrate diligence on the part of the insurance broker, I would probably take it personally. But if they went to 2 companies and then just presented the cheaper of the 2, work with someone who's going to bring their A game and wants to earn your business. That's my advice.
Yeah, no, I appreciate that. That's great. Calvin, what about what are some of the most important metrics that you track? Could be personally or professionally.
So on property accounts specifically, I look at not the premium, I look at the rate. And the rate is the cost in premium per $100 in building coverage. If you're getting, quotes from 2 or 3 insurance brokers, whoever wants the deal the most and is willing to butcher the application to get to that end will produce the lowest price. It's one of those things where you can make the price kind of whatever you want it to be. The question is, will coverage respond without incident? That's kind of the $1 million kicker. So when I'm comparing my competing bid against someone else's policy, I'm not looking at the final dollar premium. I'm looking at the rate, because that is the objective measurement that I use to compare pricing between companies. Now, I'll give an example. I had a apartment complex in Michigan. It was a 50-unit single building in Imlay City, Michigan, kind of rural country area, maybe an hour and a half north of Detroit, up in the thumb. And this building was formerly a high school. It was gut renovated in 2005. Had sprinklers. It's a pretty nice Class B, kind of cool historic property. It's on auto owners' paper right now. Auto owners mandates that you insure a property for at least 80% of what it would cost to rebuild. I figured that it would cost around $10 million to completely rebuild this building, should it go up in flames tonight. The client on his current policy had a building limit of $2.5 million. So if you're supposed to have a minimum of 80%, he has 25%. they'll divide the amount of coverage you have, 2.5 million, by the minimum you should have had, 8 million, 80%. That percent, the result of the division of those two numbers, maybe 32% or 33%, is what you're going to get paid on the claim. So if you have $1 million loss, you get 33% minus your deductible, of course. So on that deal, I came in, I think, like 20% more expensive. He was paying like $8,000 a year. I came in around 10. Well, on a purely price basis, I would be losing. But on a rate basis, the
no
amount
comparison.
Exactly. I'm beating them by probably 60-70%.
Yeah, no comparison. And that's a bad day followed by a worse day.
Yep.
Not only did you have a building burn, man, it's such a hassle. Unfortunately, we've had that gone through that process. But that's even a worse day when you figure out, hey, we're not getting as much insurance money back as we had expected or hoped, right? Man. So that's a great response, and thinking through, it's not just what the cost, right? You have to think about the coverage and what you're actually going to get paid if something happens. That's why you have it, right? That's why you have it. What about some habits that you're disciplined about, Calvin, that have produced a highest return for you?
Move quickly. Haste kills all deals. If someone comes to you, they're underwriting a 48 unit acquisition or a duplex or whatever property, get them a number within 2 hours. Could be even a range. I think it will be between X and Y, and then we'll formally quote this and get it past underwriting once you get it under contract and looks a little bit more serious. But just move quickly. Don't be that insurance broker who takes a week to respond. It bugs me when I'm working with my industry colleagues and they play those games. So I can understand and respect how the public would be turned off by haste. I can't stand it.
How do you like to give back?
So we do several volunteer events each year, and I'm a big believer in contributing to local charities. One, it's the right thing to do. If you have means, provide for others where you can. You don't need to give away all your money, but just try to reciprocate goodwill to the community. I think it's just the right approach.
Calvin, pleasure to meet you and to really dive in more in the master policy approach, what that is, and really some pros and cons that probably all of us should consider, or at least speak to somebody like yourself to say, hey, am I a good fit for that? Could it save us some money? Would it, how would we set that up? And talk through that for our personal portfolio or investment strategy, right? So I don't know, I appreciate your elaborating on that in a way that it kind of exposes me and the listeners to that as well. But really the state of the commercial real estate insurance as well, and what to expect right now, but over the next couple of years or few years to come, I think is very helpful as we're underwriting deals. And hey, that's a big expense line, right? We need to know what to expect. We need to know what to put in there and try to be as accurate as we possibly can be. Calvin, how can the listeners get in touch with you and learn more about you?
Email, phone call, Facebook, LinkedIn, carrier pigeon, smoke signal. I'm extremely responsive. Whatever your preferred method of communication is works perfectly for me.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.